The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Megan Cox. I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar, Harnessing the 4 Most Crucial Drivers of Growth in 2025. As the industry's leading provider of data, analytics, and technologies, we are here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send you the recording and the deck via email. Okay, Bob, let's begin.
Good afternoon, all of the clients on the call. We're excited to have you as we discuss harnessing the 4 crucial drivers of growth for 2025. For those of you who are prospects and not core clients, we just want to give a brief overview of who we are and how we've matured over the past year. We are, as Megan mentioned, the leading provider of data and advice to our clients across markets, channels, and increasingly messaging or AI optimization. What makes us different from most advisory firms or technology vendors is that we are a combination of the two, and that we actually have live data feeding our ongoing practical insights and strategies for clients to implement. We have a wealth of data assets, as you can see here on the upper left. This is just a small selection and not a me-see representation, but the crown jewel, 50% of all deposits at the account level, and increasingly almost 45% of all mortgages at the account level. In addition, we also have the channels in terms of branches and marketing spend that give us unique lenses into how clients not only respond to price, but how they respond to different incentives, delivery structures, and marketing messaging along the way. We work with the majority of the institutions across the top 500 US, the top 100 US, over the top 50 globally, and increasingly 1,500 clients on a global footprint. We partner with a number of institutions and are often cited by a number of the scholarly articles, as well as news outlets throughout the US and internationally, and partner with the CBA, Small Business Innovate, Strata, and others like the MBCA. So we span the atmosphere of small and large banks as well, and regularly partner with investment banks on M&A due diligence, strategy development, balance sheet optimization, regulatory response. While we work with a number of investment banks, below is just a small list. Joining us today on the call will be myself. I'm a managing director, lead our client strategies for mid-tier operations and mid-tier banks. Adam Stockton, managing director of our retail deposits and lending practice. Olivia Liu, director of our product value, prop, and strategy development. Peter Serene, our managing director in our advisory markets practice across commercial, wealth, and retail. And Rich Martin, SVP of retail lending, also covering small business, HELOC, and unsecured lending aspects. While we go through some of the industry overviews here in a second, I do want to let everyone know we do have a question answer box that you can shoot questions into within the program itself. But if for any reason you can't get it to work, because GoToWebinar is so great, please don't hesitate to email me questions directly at bob.warnock@curinos.com, and we'll address the questions as they come in. Before we jump into the 4 main drivers, we wanted to set the stage. Really, what we're going to do here is discuss a few of the core drivers. Look, third quarter net income results were positive year over year, and we broke a trend actually on revenue growth for the first time in over 6 quarters in terms of actually driving year over year growth. We're expecting positive operating leverage to start to percolate in the 4th quarter after being negative for the past 6 quarters. But overall, the messaging is that we haven't seen this translate to overall shareholder returns, basically indicating that we do see quite a bit of optimization being left on the table, either from an interest expense, an interest income, or non-interest income lever, and the associated expenses with the operating model to deliver said strategies. And then, as we jump into the 4 key themes. We're going to provide a quick overview, navigating the rate environment, the falling rate environment as some are hoping. And while it does offer a reprieve, we have seen a number of our clients continuing to war game out various scenarios of what could and could not occur in the event that we either do normalize at this level already, maybe get 1 or 2 more cuts before the end of the year, or potentially see something like we saw in the 70s and 80s. All of this means that we do require a much more tactical execution strategy for capturing margin across our cohorts. Additionally, we are helping a number of clients focus on adapting to the change in consumer behaviors. Both in terms of the retail as well as the business banking and wealth clientele, away from branches, away from in-person service, and more towards leveraging marketing, product, and experience for differentiating primary customer growth and primacy within the customer behavior itself. Harnessing the power of personalization or personalizing and AI. We understand that personalization is a repetitive topic from many of the technology vendors. We're going to kind of put a little bit of a bow on it, with the point being that we've solved this for deepening, especially while optimizing for the acquisition costs, while driving the right customers through the onboarding and deepening journeys to ensure that the revenue growth accelerates. And then finally, adapting to an evolving market and regulatory landscape, especially post the Trump administration changes that are starting to take place, as we've already seen, in terms of nominations and their associated plans or past actions. A little bit of a wild card on number 4. We'll happily address any of the ongoing questions that might come out, and we are completely aware that the shifting seas below us are constantly in swirl as we see new names appear for every cabinet position possible. All right, now with that said, I think it's good for us to start with navigating the rate environment. And Adam, and if you want to start to take a crack at this alongside Peter, I think it's good for you guys to kind of lay out to us what you're seeing with our clients, how they're navigating it, what strategies they're utilizing, and where some potential pitfalls are.
Yeah, absolutely. Thanks, Bob. We'll start from the deposit side here, and then we'll get into the lending side as well. So on the deposit side, what we've done here is just looked at the beta in the first 50 basis points of rate cuts for the current cycle as compared to the last cycle in 2019. So, just the beginning of the falling rate cycle, and just to orient everybody, a higher beta here means more pass-through. So the 49% in that blue bar for direct banks means that of the 50 basis points of rate cuts, 24, 25 basis points have come out of interest expense. So interest expenses has gone down 49% of what the Fed did. Overall, what we're seeing from a deposit perspective, I would categorize as 2 things. First, banks have been able, and credit unions have been able to pass through more beta than they did last cycle. So I think that's coming from a couple things. One is coming from a higher rate ending point. The second is more of a kind of cost posture among a majority of financial institutions. And the third is a less acute need for deposit growth at a majority of institutions. So, the good news, excluding consumer for the moment, is more pass-through. The less good news is those betas on the downside are still far lower than what they were on the upside. Most CFOs and treasurers have gone into this environment expecting downward beta to equal upward beta. Hey, if we increased rates, at 60 or 80% of what the Fed did, shouldn't we be able to come down the same way? That hasn't been true anywhere, and is particularly difficult in consumer, where you have huge portions of the book that have stayed at floor rates. There's been continued remixing from checking and low rate savings into higher rate deposits, and where new money coming into the bank is still coming in at a 3 or 4% level at many FIs. So we actually see consumer, despite the fact that headline rates have come down, the portfolio rates have actually gone up over the same time period due to that remixing. Peter, maybe you could talk for a minute about then kind of what's different in commercial. Why has commercial in particular been so successful this time around compared to prior cycles?
Sure. Well, I think you touched on this in your opening remarks. As we were in a prolonged sort of plateau at the top of the rate cycle, a lot of the MMDA balances really priced up over that time to near the top of the market. So there wasn't as much of a back book. And as you can see, banks have been extraordinarily successful bringing those down. The flip side of it, and this is how you get to that 43% overall figure, is the balances near the floor. You see that in the non-interest bearing deposits and ECRs, and also to an extent in interest checking, where there is some back book, particularly from some of the smaller customers, where those balances look a little bit more like consumer rates. And so what you see is really kind of a mix. As we look forward on this, one of the things that will be very important is how quickly and how far we come down. All else equal, a sort of short and sharp path down on rates probably takes some of the pressure off of that remixing. Whereas if we stay prolonged at a relatively higher level of rates, then there's some risk to that non-interest bearing book remixing, which could dampen overall betas as we get deeper into the cycle.
Yeah,
Rich,
sorry, go ahead, Bob.
I was going to say, Rich, do you want to kind of highlight some of the asset side of the equation before we jump into how they play off on the margin, which I think is where Adam was going to jump into?
Yeah, I would, Bob, you started with it. As we think about lending, it's really to us this intersection of offering the right product to the right customer through the right channel, right? And channel can be, you mentioned branch earlier, can be desktop, now mobile, but in the lending side particularly, so much of that has changed from an optionality perspective. We are not quite yet in a low rate environment. I always like to put out that headline that despite the Fed cutting rates, we're not seeing that one-to-one or a larger correlation to that dip in rates. We do expect that in the more near term, medium term, but the landscape has changed. We've had a lot of new entrants on the lending side, the plethora of loan products and alternative products in lending specifically, not just mortgage, not just home equity, but unsecured as well. Borrowers today, consumers today have more options than they've ever had before. And I think it's really about augmenting that right product channel and messaging is ultimately, are you offering the best or most appropriate product to that consumer at the right time, since so much of it is situational. But we're definitely seeing that landscape change with new entrants. That's heightened competition. And as a result, we're seeing a lower overall addressable market in terms of the highs we saw in 20 and 21. And with that, we're having a little bit of consolidation within that marketplace, but largely, a similar number of institutions out there competing for that smaller pie. And so we're seeing those competitive pressures intensify.
Thanks, Rich. And I think that plays into a nice way to discuss some of the margin and how to defend your potential advantages as our clients. Roughly through the third quarter of 2024, half of the banks in the U.S. saw NIM increases, while another half witnessed a NIM decrease. And this is at a time where almost 2/3 to 3/4 of banks overall in the U.S. started to decrease their asset sensitivity and increase their liability sensitivity since the second quarter. I think that we want to pay very mindful attention to that. And Adam and Peter, if you want, can you kind of discuss some of the defensive tactics that our clients are positioning for in terms of 2025 and beyond, in terms of not only price, but then leading into our next 2 points on personalization and meeting the clients to where they are.
Yeah, absolutely. I'm happy to start, and Peter, you can kind of jump in and feel free to augment as well. In terms of defensive tactics, I think it's a really tight angle on segmentation and tactical pricing for one. Understanding what of your customer segments really need rate, where will rate change their behavior, and where will it not, and then acting on that really surgically. A key part of that is also making sure that anything that you're doing to refill the bucket on the other side isn't impacting the work that you're doing from a down pricing side on deposits. And so are you running a mass promotion to try and drive in new balances that ends up undoing a lot of the hard work that you did to reprice some of your balances down the curve? And so it's not just taking each of those decisions individually, but it's looking at them much more broadly. On the lending side, then, and Rich, you can jump in here as well. As rates come down, there's still opportunities in some segments of lending. Home equity has historically been a more of a relationship product, although that market is being disrupted to some extent. Where there are opportunities to put on some lending volume at healthier margin. But again, you have to be really surgical about finding those opportunities and taking advantage of them without broader resegmentation.
Yeah, I would add, Adam, I think that's an important point. I mean, there's definitely a product cannibalization aspect as you think about the opportunities, but I do think largely, I would characterize home equity as almost a sleeping giant. And I think a lot of people the last few years have talked about when the rate cycle, normalizes, rates do start to come down to what degree and at what pace, over time. But home equity will just fade away, and people will revert back to the mortgage option that was all of 20 and 21 with 2 and 3% first mortgage rates, or unsecured or other options, buy now, pay later type options. But I do think it's important to kind of contextualize, where we find ourselves in a low rate environment. Traditionally, consumers are going to access liquidity through mortgage financing. That's not really an option today from an economic standpoint, right? The rate differential is still in the few hundred basis point range. We know mortgage rates sit at about 7% today, with home equity options, both closed-end and line of credit, in the, call it 8 to 9% range, and unsecured, at the higher end, probably in the, call it 11 to 12% range. The pace at which those come down, I think, to Adam, to your point, is where we see that opportunity, and we see the most opportunity, particularly in home equity. That's going to give customers, again, the highest degree of flexibility relative to mortgage. We know folks have tappable equity. Just in the last 5 years alone, total equity outstanding has increased 73% to almost $34 trillion. We also know there's other factors, as well as increasing property taxes, insurance premiums. All that's playing and kind of coupling the effect of, the end of the day, folks are staying in their homes longer. There isn't much inventory, so I can't really upgrade, purchase a bigger home. So we see a lot of those forces contributing to pretty significant tailwind for equity as we think about the next 12 to 18 months. Mortgage being less of that traditional financing option. I do think as well, though, on the unsecured side, we've seen a little bit more resiliency in unsecured in the last few years as we think about the change in the rate cycle and where we're at. We do see, from a general volume position perspective, we're seeing a little bit more resiliency there. And again, that's that adapting to those changing behaviors, folks looking into unsecured option potentially as a better situational fit. The convenience aspect, we know in the marketplace today, as many of our clients I'm sure can attest, it still takes roughly 40 days to close a home equity product, where you're about a quarter of the time on the unsecured side or personal loan side. It is more of just shifting from at the end of the day, what is my rate? And there being that potential sticker shock with elevated rates, but also what are those alternatives? And I think what we're hearing and seeing in the data is, and a good segue to some of the other topics, rate doesn't always win at the end of the day. Speed and convenience play a pretty critical component to that equation.
Thanks, Rich. I think you inadvertently, but thankfully started to bleed into adapting to the changing consumer behaviors topic, which is kind of meeting those customers where they're at and designing products, especially on the HELOC side, to help mitigate some of those client debt burden needs, while also potentially helping the margin of the institution at hand. I think it's a good time for us to shift over to Olivia to discuss some of the other topics within changing consumer demand across not only small business, but how are we as an industry starting to augment or change our strategies in a world where client interaction at the physical mediums are down. Despite the number of banking institutions being decreased by significant numbers in the mid double digits over the past 5 years, the branch number has not kept pace even through the post-COVID pandemic era. So, Olivia, do you want to start digging into this topic?
Yeah, for sure. And so from the consumer behavior perspective, and we'll start with the retail side of things. As you can tell, even from this particular chart, consumer behaviors have shifted drastically in the past. And so that bright blue bar that represents not only marketing investment in the marketplace, but also your ability to just be distinctive, to be differentiated in the marketplace. So dependent on what you stand for, that's really the biggest driver now behind your primary bank choice. And that black bar at the bottom, the branch share bars continue to go down and diminish in as a driver toward that bank choice. Now, it's not to say that branch share or branches are not important. Your footprint is extremely important, and in fact, branches now really remains one of the biggest drivers to how well you stay top of mind for consumers. So your level of awareness is highly dependent on some of your physical assets that are within your physical network overall. But we are seeing that the utilization of branches as a form of service really decline over time. And so really much of it is highly dependent and then on your marketing and differentiation within the marketplace. The one thing I'll point out here, and this kind of speaks to where Rich talked about a little bit about this earlier in terms of convenience. You see that teal bar, the digital bar. And some of you folks out there who are maybe on the digital teams, right, you see it kind of decline over time. And at this point, it's a really small driver in terms of acquisition, which is interesting because although it was certainly an acquisition driver, and we saw it kind of increase pre-pandemic, at this point, it's now so much of a table stake that, of course you're going to have a good digital experience. And that's why it's not even a factor anymore in terms of choosing one player over another player. However, it is a huge driver now of attrition on the other end. So it's not to say that digital experiences are not important, but on the other, if you don't have up to par or up to standard digital experiences, we tend to see it on the attrition side of things. And so this gives us a sense that when we think about how you go to market, then we have to rethink how marketing, product, your distribution and experience along with pricing really can come together in order for you to kind of win in the future as this consumer demands really shift. With that, I'll start this. We're seeing similar trends, and I'll invite both Adam and Peter on this front too, on the small business side of things, is that we're seeing the same exact trend within the small business space. And we know that we've heard a lot from institutions within the space. We're trying to get a sense of how to actually win within small business. We're also seeing similar trends in terms of shifting a bit away from actual locations, but it's more about the products and services then in terms of value proposition.
Yeah, Olivia, I think that's spot on. In small business, the one thing that's not as explicitly called out in this on the page here is the innovation in the product, and in some sense a redefinition of what a product actually means. So the notion that you can ride the chassis of a deposit product, but that's also the nexus of how you make and receive your payments, and increasingly the vehicle through which you get added insights to help optimize how you run your business is really emerging as one of the frontiers that banks are competing on for share of mind and share of wallet in the small business space.
Maybe I'd point out the one other thing there too, which is increasing shift toward relationship. So many financial institutions used to think about small business lending on one hand, and then deposits were, often an afterthought, or at best a different group, kind of coming in after making the loan to sweep in the deposit relationship. I think businesses are demanding more of a holistic approach from their vendors, and that even crosses segment lines. Businesses have been asking for a really long time, why do you not give me these benefits on the personal side when I have this business relationship, or vice versa? Why are you giving me the benefits over here, not over there? For a long time, banks kind of fell back on, we just don't have the data, or it's really hard for us to connect to you. We'll do it as a one-off exception. But now business owners are seeing that in all other facets of their life. And they're saying, if all of these other apps can recognize who I am, why can't you? And so, getting the kind of holistic relationship approach to small businesses is one of the other kind of key trends moving forward there.
It's actually a good point, Adam. I think that we, and Olivia, definitely want you to jump in, and Peter as well. How are we seeing this manifest itself in terms of chalk lines? Too much we've seen the approach of retail products for small business that often fall short, or commercial pricing for business banking products that often cause confusion. And then we also, in tangential to that, we also see a big push to meeting the clients out in the field with digital capabilities, oftentimes, again, brought from either the retail or commercial orgs that are not fit for purpose. How are we starting to see these trends evolve and impact the meeting the client and changing customer behavior?
Peter, I think
some of the larger.
Nope, never mind. Just coming through with the line. Sorry.
One of the things we've seen from some of the larger banks is actually a shifting up of the chalk line on business banking. And one of the acknowledgments that I think is inherent in that is that for a lot of these companies that are 10, 20, even $50 million a year businesses, we've made things too complicated with the commercial product set. And so it's really forcing innovation in the small business product set, the small business service model, to solve a broader, more complex set of customer needs with the simplicity that is a benefit of the small business product set relative to a commercial-oriented product set.
Yeah, and I'll echo and follow up on what Peter just said too. Exactly the trend that we're all seeing across the board. One thing that we're starting to see more of, and people are asking more of, is how do we think about segments within small business and business banking? And it usually, right, our typical definitions revolve around your industry, revolve around your revenue size overall. Absolutely makes sense, especially from a pure marketing targeting or pure targeting perspective for your front line. However, if we're going to compete in the product and differentiation space, we need to figure out what these business owners actually want. And so this means going beyond just the industry, going beyond just the revenue size. We need to get into really the white spaces attached to different types of business owners in the space. In fact, one of the most stark differences in terms of what differentiates one business owner from another, a key dimension that we've found as an example, is whether or not someone views their business as a part of their identity. It's a business they want to grow with, and they're looking for a partner to help grow their baby with, really, versus someone who views their business as more of a source of steady income. Those two business owners might have very interesting or very similar needs from a pure feature by feature perspective, but the way you talk about the feature, what you prioritize on the roadmap becomes extremely different then, and that spans across revenue sizes as well as industries.
No, thank you both
Bob,
for those insights.
At the risk of doubling back a little bit here, I also want to connect this to where you started on the question before around how we combat margin compression. And I think we're inverting the sports metaphor here, but I'll say the best defense is a good offense in this case. And all of these things that we're talking about are how we attract the least rate sensitive segments of the deposit portfolio. And so really these are two sides of the coin that are essential to being able to move forward with a sustainably low cost deposit base as in any rate scenario that we're presented with.
No, I think that's exactly where I was going to go. I love it when my job's done for me. It makes my life really easy. So thank you, Peter. I think one of the things that ties into that, though, is being on a good offense on the lending side, too, which historically has been where business banking has been. What we do see, though, today is an interesting dynamic where we're not harvesting or deepening these relationships to matriculate with the bank because we've relied too much on a credit-only approach. One of the unique situations that we're seeing in our data today and in the industry at large is there is a significant decline in the supply of credit being offered to business banks or to business banking clients within the community. While that said, we do see a massive increase in demand across clients for a number of products. And what's happening is the banks are only meeting them within the SBA product set and not offering or developing a differentiated chassis to help grow and matriculate that client relationship beyond just the lending need. Rich, I don't know, you want to touch on some of the lending dynamics that we're seeing and maybe a cautionary tale?
Yeah, absolutely cautionary. I think that's the big piece. I think there's a more profound or significant misalignment here in where's demand today from an application or access to credit perspective. I think the perception piece is also key. The perception that the necessary credit is available should I need it, especially in the small business side. But yeah, you've got that misalignment today. You see it in equity, you see it in mortgage, where look, with these cyclical changes in volume, that's where we tend to see product innovation. We tend to see value prop change. It's again going back to my earlier comment on approaching it through that nexus of the right product to the right channel, and really understanding, what are those situational factors where there's a significant and not only just current demand, it's future demand, right? You think about household formation, where's that future demand going to come from? And it's largely going to be on those underserved segments today. So, that is something I think is, I'm sure many of our clients and I hold are cautiously optimistic. It's where these lower rates will create those opportunities, but that access to credit is key. Similarly, structurally, just from a supply shortage perspective, right? Lower rates don't solve this conundrum for the marketplace, right? You need to see inventory return to the market. That's not the case today. We can't build our way out of this, at least not in the short term. But you're absolutely right in meeting those needs. And that access to credit, both near term and longer term, that's where I think the demand you'll see over time is going to come from. And if it's not met, you've got that imbalance that you're seeing today.
Thanks, Rich. I think this is a good part for us to turn to the harnessing the power of personalization and AI, because it really starts to hone in on where can we meet the customers, not only from a lending perspective, but from a depository perspective. How do we deepen the relationship and funnel specific behaviors that are more cost intensive with lower revenue outcomes into different channels that can adequately serve the end customer. Olivia, I think it makes sense for you to tee up this session, but real quick, I'll just remind everyone, because we've gone through all of our questions that have been punted over, please don't hesitate to reach out either in the chat box or email me directly with your question. I did appreciate the person who cracked at my weight loss, so thank you very much. And we will jump into the AI section.
All right, from an AI perspective, one of the key themes, right, that came out of 1 and 2 just now is that it is competitive. It is extremely competitive in the marketplace, whether you're trying to get mass consumers, you're trying to get more of the premier, more emerging affluent, or all the way to really small business customers overall. The cost to acquire is extremely high. We're talking about increases of, depending on which segment, all the 60% to about 200% increase just in the last year and a half in terms of the cost to acquire. And that's likely also on the pricing side as well. From a rate perspective, we're seeing much higher rates of deposits, right? That you're really paying up for deposits coming through the door. This is where we do see a really key opportunity in deploying extremely effective personalization within your existing book, whether that means within your portfolio of customers or in consumers, or whether it means through onboarding overall. And a lot of you maybe, and I know we referenced this earlier at the call, personalization. Everyone says personalization. And I do mean the word effective here, effective personalization, because a lot of folks on the call you may be interacting with your exact tech stack, whether that means a Salesforce, a Pega, an Adobe. And the reality is that a lot of that requires more manual kind of journey building overall. When we think about effective personalization, we do mean how do we get the right message, not necessarily product, but the right message to the right person at the right channel. And this is where even some of the things that we've seen from the work we've done is that from an effective personalization perspective, you look on the chart to the left here, that blue cohort that all the way to the left that account for 40% of the population that we were really testing with. So control groups versus folks who actually received some form of smart personalization marketing. We saw much higher outsized kind of revenue, whether it be revenue that's from your money market, your investments, your credit card, your HELOC, your mortgage. We actually saw much higher uptick overall if we're able to leverage and get to the person with the right message, again, at the right time and right channel. That's the power that we could really unleash within the space. The difference, I think there are a lot of different frameworks out there in terms of how to approach it, but there's likely one where it doesn't require teams of tens of dozens of people to drive kind of manual journey building overall. And so that's where we're seeing quite a bit more usage or utilization of smart personalization that's become much more effective.
Appreciate it. So Olivia, maybe before we dive deeper into that topic, your initial comments have already sparked a flurry of questions, some along a very similar theme, which is how do we overcome compliance and regulatory concerns while personalizing offers, either from a marketing standpoint, a product standpoint, a rate standpoint, and we'll dovetail a question into that on a rate one in a few seconds. But team, I think we have a broad set of opinions on this, and as well as experience dealing with it. So Olivia, if you want to start us off, and Peter and Adam jump in.
Okay, perfect. So completely, and I hear you. I hear this is a common question that we get both on the prospecting side as well as on the targeting side. The reality is that there are two things to think about here. One is that not every, and I'll differentiate between two different types of content. One is that not every piece of content or touch point needs to revolve around an offer nor product. That is the biggest piece that I want hopefully everyone who's into personalization on this call to take away from this, is that within our space, we do not have thousands of SKUs or products on the shelf for us to do that. We're not Amazon. We have maybe 10 SKUs, 10 SKUs per segment or per line of business. And so when we think about that, it means what is the right content that's useful for that particular customer that will drive more top of mind, right? Drive top of mind awareness and consideration down the line to basically to ensure that we continue that level of engagement. That is outside of where, we think about compliance, et cetera. That is content that we believe that will be helpful for our clients overall. That's one aspect. The second aspect I'll get to, which is how do you think about products and offers then? I think there are a lot of different ways that we think about this, and it's a bit dependent on how compliance really how well you work with compliance along the way. One of the biggest, most effective pieces we have found is that we're not leveraging any sort of protected class data at all. It's more around their relationship with you and whether or not we see certain triggers that indicate a need. And so not quite along lines of, oh, we think this person has a ton of office balances elsewhere. It's more along lines of, this person seems to be looking for content or looking at content around education. Can we basically can help them figure out potentially some form of savings or some form of tips around savings for education? So it really flips on its head where we're not completely targeting, again, based on demographics or based on any protected class. It's a bit more nuanced, and this requires then a bit more sophistication in terms of the data that we have. So I'll split that into two categories. I know, Adam, I see you're pining, you're jumping in.
No, I think that's right, and you know, I was going to talk a little bit about the rate piece that Bob brought up. You know, in terms of how rate fits in and how you think about the intersection of price and you know, personalization and digital engagement. And really there are a couple pieces there. One is, in order to get the stable, low-cost deposits over time, you almost always have to start with the checking relationship. And so you can use then rate as a cross-sell vehicle into these already engaged primary customers, but do it in a much more targeted fashion. And so instead of putting a 3 or 4 or 5% rate up on big posters in your branch, which, by the way, is only going to attract current customers who go into a branch, which is not many of them anymore. Instead, you can target cohorts of more rate-sensitive customers. Now, as Olivia said, you do have to be thoughtful about the variables you use to make sure that you're not hitting protected classes. But there's an opportunity to do that pretty broadly in a way that doesn't damage your overall economics. And so we see it not as an either or, but as a yes and you have to do kind of each of those things probably in different ways than you've thought about doing in the past. As you lean more and more on personalization and targeting.
The one thing that has kind of followed through with that, Adam, is there's kind of another theme of questions coming in on the personalization side. Once we do start offering specific rates and promos, how do we avoid blowing up our interest expense beyond our budget? Let's say we have magically scored our clients and we go for all of them and we hit a higher propensity to onboard. What happens? How do we control for this out?
Yeah, that's a great question, and I can start, and Olivia, feel free to chime in here as well. I think number one is being really thoughtful about the kind of ongoing paths that those customers will take. To the extent that you're pulling imbalances from kind of deeper relationship customers, they shouldn't need to be held up at market promo or direct bank levels over the longer period of time. I think number two is, to the extent that you're being targeted, you have an opportunity to reprice less balances than you do with mass promotions, and you have to kind of balance the two out. And then the third piece is really thinking about how you trade off kind of different segments against each other given your growth needs. There may be opportunities to gather more consumer balances through through targeting and personalization, and fill the bucket with rate sensitive balances that come from commercial or wealth, where, hey, pricing up can get balances in the door quickly, even though they're more rate sensitive, but you can price individual customers already there. So a number of different tools in the toolkit to help keep interest expense under control, even as you're using rate as part of the equation.
One last quick question
Adam,
on this. One last quick question on this is just what's the commercial and wealth angle of personalization, and how does it play into, I think what Adam was tiptoeing into is what we would refer to as efficient funding optimization across lines of business.
Yeah, it's a great question. So I'll take sort of two pieces to that on the commercial side, and then I think Olivia and I can probably pick up the wealth side a little bit together. From a commercial standpoint, there's been enormous interest for years and years and years in figuring out how to position the right product or solution to customers who have very complex, particularly on the payment side, payments needs. Getting Olivia mentioned, I think, sort of 8 or 10 SKUs on the deposit shelf. That's true until you get to treasury management, when you have a couple hundred. And so I think there's enormous untapped potential to help position the next best conversation. We do tend to shy away a little bit from the notion of next best product because the needs are typically more complex. But the idea of next best conversation, let's go have a receivables conversation, or let's go have an integrated payables conversation, or let's go have a fraud conversation, is an area where I think personalization, both to the customer but also to the banker, can really help open up a lot of doors to really productive conversation. The other component to this, as we think about pricing specifically, is it really lands us back to a topic that's not entirely new, but this notion of really precise relationship pricing. Again, where you have a lot of different moving parts, there's a lot of latitude to be strategic around the way you use pricing as a lever to actually deepen relationships. But the flip side of that is you can end up, without those tools, you can end up kind of giving away the store if you relationship price every single aspect of the relationship. From a wealth standpoint, I think I would start by just saying that there's a lot of untapped opportunity to have higher quality conversations about the banking aspects of the wealth relationship. There are a lot of factors that drive that, particularly around advisor engagement and incentives, but leveraging the tools to make sure, all the tools to make sure that we're putting the range of our bank offerings in front of our wealth customers is another really really untapped area for these types of solutions. Olivia, you've got a lot of thoughts on wealth as well. So anything you want to add there?
The only thing I'll add is the fact that within the wealth space there are multiple definitions of primacy. And so this is where it gets a little more complicated, where in consumer we know generally primary customers define it as direct deposit, etc. In the wealth ecosystem, we're thinking of multiple centroids, if you will, of primacy, and we have to optimize for that with every touch point. Are we shooting for the yield aspect? So are we shooting for the investment AUM relationship? Are we shooting for that direct deposit or that banking relationship? And how do those things actually come together? It all comes down then back to segmentation. How are we actually segmenting these folks? And even when we look at folks who are a bit younger, so a bit younger in terms of the emerging high net worth, if you will, so quite a bit of assets already built up in their young 30s versus folks who are much older who have a large amount of assets, very different expectations of what they would want. And so this is a part where depending on who you're really after, taking that into account of how their ecosystem how their money ecosystem works, then becomes really important.
All right, let's jump to the final topic here in the last 10 minutes, adapting to an evolving market, regulatory landscape. I'm going to tee this up a little bit because we all have our own vantage points given some of the key questions we're getting asked by clients. It does range. One of the things that I'll tell you that has been very interesting to us has been the surge in demand that we have already seen from bank partnerships, bank entry, and the reinvigoration of the potential ILC channel for bank entry. I know most of the clients on this call are already deeply involved with banking, but it is an area that will further kind of push the competitive environment. So while we do expect a lot of regulatory tailwinds, there may also be a competitive headwind for a majority of the traditional players, given some of what we're already seeing on the regulatory front from a softening standpoint. One of the things that we're going to do here to make this a little easier in terms of the topic is, we have seen a few things that have really driven our regulatory response, increase in terms of bank M&A, and we've already seen a number of these aspects play out with deals announced repeatedly over the past 3 weeks. We anticipate that this will fully continue, as well as less restrictive regulatory environment from a capital standpoint, a CFPB standpoint, an overall discern on certain fees and things. And I do want to double click on this. We'll come back to it. There are some things that are already so far instilled, or the cow's out of the barn, if you will, that they're just not going to come back. Think of overdraft regulation, et cetera. Olivia will let you chime in on that. And then a wider range of possible rate scenarios as a longer term tail, just given some of the inflationary impacts that we're going to see and potential pro-business growth aspects as well. So a lot of topics to jump into. Already seen a few questions populate in the channel and in the inbox. But Peter, where would you like to start?
Yeah, Bob, I think you've covered the waterfront pretty well in terms of the questions that we're starting to get, the categories on the left side of the page. Maybe to tee it up, I'll just share some of our preliminary thoughts about what do we do about all of these. And with the caveat that there's a whole lot of uncertainty about exactly what policy will look like, we actually think there's a pretty narrow set of common sense things that many should be doing. So, on the M&A standpoint, the first thing that we would kind of remind everybody of is the sort of the crown jewel of any deal is the value of the deposit book. And so, particularly for anybody who might consider themselves a target, the time is now to kind of polish those up. And on the other side of the table, potential acquirers, in terms of building up the value of your acquisition currency if it's stock, certainly that's the lever that you can pull really quickly now in terms of driving up earnings. The other is just being on the front foot in terms of a more dynamic environment. So, more deals means churn in customers and churn in talent. And so, thinking about being on the front foot from an organizational standpoint forward, thinking about your strategies, as well as the segments that you really want to differentiate yourselves in. Being really clear on that now will set you up to capitalize on sort of any more activity on the customer and talent front. The regulatory environment, we can't foresee the exact changes in regulation, but the direction of travel, if we end up, sort of in a less restrictive environment, is more competition. And what do we need to do to prepare for that? Well, we need to have our acquisition engine ready to go. So, we tied back to a lot of the things we talked about around personalization, around marketing, around products, and around having a sales force that's really optimized. That's another question we've gotten from a lot of our clients recently: is how do we get our sales force properly positioned to go out and compete a little bit more aggressively? Those are the things that we think will help you adapt to whatever comes down the pipeline on number two. And then on the rate scenario.
Real quick before we jump into number three,
yeah.
Just because I'm getting a few questions here, can we be a little prescriptive on the items that we think will not see reprieve? Overdraft, potentially 1071. Do we have an opinion on this? I will caveat we are not regulatory experts nor advisors, but we are.
I'm going to chime in on the overdraft piece. that is sailed. That will continue. That is not going, there is no coming back from that. And so we do expect that to continue to drive lower really fee revenue overall, with especially within the consumer space. And we expect most of that to hit by mid 2026 across the industry. And so that we do not expect to come back.
I would say on the lending side, Bob, just from a general demand, I mean, I'm not going to postulate on the future of Fannie Freddie, but I do think just overall kind of what's government's role in housing. You know, I think the one good tailwind we have is Wall Street becoming more interested in this collateral, you know, lending collateral, and you saw issuance more than double this year, projected to increase in the next year. Like there is going to be increased you know, private demand for loan collateral, and that's mortgage, unsecured, and home equity. So I do see that from a competitive standpoint, assuming if government with some regulation, you know, dropping FHA premiums is one within mortgage, that could have profound effects. Capital gains taxes could help with some of the supply issues. There's some other tangible things, but I do think the private market and how credit is priced is something that I do think some of that increased demand and appetite will sustain.
Thanks, Rich. Peter, do you want to jump into the final one?
Yeah, look, I think one of the takeaways from what we learned going through the rate cycle that we've just been through is, by and large, banks did a good job of managing pricing within their lines of business. But because it's been so long since there's been such a differentiation in the cost and value of different deposit pools across lines of business, one of the areas where we saw, you know, a lot of sort of strategic hand wringing from a number of banks was how to think about trading those deposit pools off. How do we think about the extent to which a business should be self-funding within itself, or whether there should be businesses that contribute more on the asset side or more on the lending side? In an environment where, you know, you look at the bond market, you look at Fed funds futures, they're kind of telling us, I don't know, in terms of where things are going. But if you take that as you've got kind of a wider cone of uncertainty, that means there are more of these decisions to come around how we trade off deposit pools. A lot of the things that we were just talking about at the tail end of the personalization discussion, actually. And so that is, if you focus on those issues, developing those tools to manage not just within lines of business customer segments, but across, then you're going to be well set up for whatever the rate environment is.
All right. Thank you, Peter. Just one final offer for questions in the last 2 minutes. And actually, wow, yes, the slide deck will be made available afterwards. We will be providing it to all attendees as well as those requesting the replay who could not attend. So with that said, I think we're going to yield the rest of the time back to your lovely days and thank the panelists for their time and insights. If you have any additional questions, please don't hesitate to reach out to either of us directly or your associated Curinos individual. With that, thank you for the time, and we enjoyed the discussion today.